So, good morning class. Okay. I hope you remember what we discussed regarding capital structure, or should I repeat it once again? You want me to repeat it? Okay. Now what is capital structure? We shall repeat it very fast. What is capital structure? Stock. Okay. What is capital structure? Issuing bonds is there, stocks are there. What do you mean by capital structure? You know what is capital? Capital is the one thing by using we will do our business. For that it doesn't matter whether it is a individual firm, a partnership or a joint stock company, right? Capital is necessary for every organization. Now here under third chapter we would be studying how the capital of any business organization would be composed of, and in different situations what are the decisions should be taken by a manager. That is to tell, usually or traditionally the capital would be made of two of the financial instruments. Either it would be a debt instrument or it would be a equity. Yes. Now under debt there are many different kinds. Now whatever we take it from outsider in the form of loan would be regarded as debt. Now equity is different because when we issue equity we would also be issuing the ownership right. Now that's where debt and equity are two different things. Yes. Now usually whatever capital our organization takes up, it would come in the purview of either debt or in the purview of equity. Now there are chances that the organization's capital could be composed fully of debt, it could be composing fully of equity, or combination of both, or a combination of anything which can be included in either debt or in equity. Now having said that, how the capital should be composing of is nothing but capital structure. Now this capital structure, as we have discussed, depends upon many things. Okay, usually it might depend on the size of the business, the nature of the business, how those who would be giving loan perceive your business. If at all the market is such that it trusts your organization and your organization's capital could be made up of only equity, then there are chances that the company might go entirely for equity. Yes. Now if at all the company feels that, other than giving out money for or dividing it between many of them, if we go for debt, we can have all the money in the organization. Not only that, the tax also plays a major role. One of the things we had discussed under this only, let us see that. Now, yes, speaking about that, there has been a definition given by Bogan, and he tells that capital structure may consist of a single class of stock, or it may comprise several issues of bonds and preferred stocks, the characteristics which may vary considerably. Now when I tell capital structure, I would mention debt, equity or different kinds of instruments. But for you to understand it, you should know what are the features of equity, what are the features of debt maybe, or for that matter bond. All those things you would have known earlier. Okay? If at all you want, you can make a point of all those things. Because when I tell debt, everything that could be included in debt will come. When I tell equity, all the things regarding equity will come into effect. And telling that again and again will not be possible. That's why when we were discussing first lesson, each and everything was discussed bit by bit and sentence by sentence. Now, if at all you have any difficulties, you have the handout of first chapter. Go to that, read it once again. You will understand it better if you have doubt. Okay? Now, the main thing that we said regarding capital structure was capital is the one thing which is used to create additional money or additional capital. Now, speaking regarding not only debt and equity we spoke, one more characteristics regarding debt and equity that you should remember is both short term and long term finance are necessary for an organization. Whenever they need short term, usually they would go for it. Whenever they need long term, they would go for equity. Now, this was the formula which we consider when we will have to find out the total capital structure. Now, the total capital structure would be including the entire net worth of the organization, the preferred stocks and also long term debt. Now, what you can do is when you take down notes, you write only what is not there, because this I would be anyhow sharing. Okay? Otherwise, what happens is that you will have to listen, you will have to see, you will have to write, might be difficult. So, once we complete the chapter, I will give you the handout. Otherwise, what you can do is on your Google Meet, just take the screenshot of all those things, because this would be shared there also. Okay. Now, total assets minus current liability will also give you capital structure. Here, why they have current liabilities is just because the capital structure is nothing but your long term liabilities. Correct? Whatever comes in the left hand side of your balance sheet, that would be your capital structure. Now, factor influencing also we have discussed. Now, these factors including can be divided into internal factors, external and general. Now, internal specifically to the organization, it differs from one company to another company, and it also changes when the same company has different branches also. Okay? Now, in that we considered regarding cost of capital. Now, cost of capital is nothing but you have the capital structure. Now, each kind of capital will attract its own cost. When it is debt, you will have to pay the interest, that would be the main cost. When it is equity, while issuing and other things, you will be attracting the cost. Okay? Now, the next one is risk. All those things I will not repeat it once again. Now, dilution of value is nothing but where you give more concern regarding whether you want to distribute the ownership of the company among many, or you would like to have it in the hands of few. The more and more we give equity, it simply means the value of the company is being diluted. Yes, the external factors are nothing but which would be specific for the industry or two or more companies, and the general factors would be of the economy, right? The size, business and characteristics, growth, age and size of the firm. Now, growth, age and size of the firm especially matters maybe until now you never went for equity, okay, your company, and that your company might be surviving in the market for a certain long term period. People would be having some kind of faith in your business. Under such scenarios, to go for equity becomes easier. That is to tell, as soon as you list your stock, there would be investors willing to invest in your company. Now, this was the particular example we saw wherein all other factors remaining same of an organization. What happens if they consider debt in their capital and if they compose their capital out of equity? The rest thing here would be the same, right? Now, see here. Now, the outlay or the project requires 5 lakh rupees. Now, they have taken two options. First option, they have taken 6% debt, and in next option they have taken 6% preference shares. Okay. Now, stock is nothing but collectively when there are many different kinds of shares, it is being called as stock. Now, here this 12% on project outlay is what we have considered. That would be the EBIT. So, it comes down to 60,000. EBIT is nothing but earning before interest and tax. So, when we have EBIT and we will have to find what each of the partners would be getting, first if at all there are any interest, we will have to pay it out. So, interest is being considered only under first option because in the second option there aren't any kind of debt taken. So, 6% on 5 lakh would be 30,000, right. Now, 5 lakh into 10% would be 5,000, 5 into 6 would be 30. Calculators are there? Yes. Now, when you deduct the interest, you will get earnings before tax. Now, tax is also here we have taken based on the assumption. Yes? Earning before tax is 60,000 minus 30,000 is 30,000 what you have got there. Okay. In the second option what has happened is that because it is made up of preference shares and there aren't any kind of debt, you cannot deduct the interest. That is how in the second option you have 60,000 earning before tax. Now, tax would be mandatory. It does not matter whether your capital is made out of debt or whether your capital is made out of equity. For your organization, for the government, you will have to pay the tax. So, 40% was the general tax rate. So, we had taken 40%. Now, we will have to go and find what is the general tax rate for corporations or your joint stock company. Now, whenever you solve, that is what do. Whenever there is some kind of confusion, you should give note under strategic financial management or tax planning and also SAPF. Because when you give note, what happens is that we will know why you have taken certain or done certain treatment for this. Okay. Now, tax would be on EBIT, that is 40%, 4 3s it is 12, 6 4s are 24. That is how you got 30,000 and 12,000 and 24,000. Now, that is the net income available to net income after tax. Okay. Now, that is not distributed among the owners. Again, you will have to pay dividend at 6%. Now dividend is payable only for the second kind, because debt we have already paid interest, and for dividend for preference shares we are paying the dividend. Okay, and 6% on what? Yes, 6% on 5 lakh. Why? Because the entire capital you will have to pay the dividend. Okay. So 6% on 5 lakh is again 30,000. But see, what is the earning available to equity shareholders or the owners? When they have taken debt, it is more. When they have taken equity, it is less. Why? That happened because of the tax, nothing else. Because here you see, earning, interest of 6% will also be 30,000, and dividend 6% will also be 30,000. But then because of the payment of tax, the amount available for the owners would be different. That is why under capital structure it is said that up until that portion wherein the debt would be advantageous, it is preferably that capital structure is made out of debt. For every company there would be certain limit, like we had in cost accounting, we have that break even point. Now for debt and equity also there would be something like that. Some portion you can have it of debt which would be favorable for the organization, but it doesn't mean that if at all the entire thing is made of debt also it would be helpful. That is never going to happen. After certain point, now we tend to tell after certain point because now that particular point would be different for each organization. Okay. After that point, even then if you take only debt, that might not be favorable for your organization. Now here under such things the work of the financial manager comes into play. He'll have to decide, he'll have to study, he'll have to analyze and tell until what kind of capital we can do, and if we are taking both, until what amount it is benefited that we take debt, after what point we will have to take equity. Now until there I guess we had discussed in our last class. Now the next one, this also I guess I had shared, optimum capital structure, but then I know my students more than anything else, so the recorded video will be only for me. Whatever I have said in recorded video, it is there. Yes, it's there in your Telegram group I guess. Now that was shared in Telegram because the YouTube was not accepting the other day, or there might have been some internet issues. Okay. Now you do know what is capital structure. Now what is this once again optimum capital structure? What is that? Now it on the part of the financial manager, it becomes necessary that he will have to come up with the optimum capital structure. Now at least in terms of English word, what is this optimum? Why optimum? Yes, what is this optimum capital structure? Yes, Raksha? Yes, you can tell. See, there is no answer is wrong. You'll have, if at all it is something different, you can change it. What is optimum capital? As much as possible, no. Optimum in the sense, a perfect match of debt and equity. Okay? How much portion of, now, if at all it is a, now total capital structure would be 100%, right? Now optimum capital structure tells that how much portion should be debt, how much portion should be equity. Now usually when they do is, how we calculate is, maybe out of the total amount that is necessary, first we will have to find out the cost of each capital. Now what is the cost of debt, what is the cost of equity, we should know, or for that matter any kind of instrument that you take, the cost of each of that would be known. After that you will calculate. How you would calculate is, maybe first instance you will take 90% equity, 10% debt, 80% equity, 20% debt, or of the same ratios, and you would see together it becomes 100%. Now you will start assigning the cost of each, and there would be a certain ratio wherein the cost would come for the lowest possible amount. Now that particular ratio would be regarded as optimum capital structure. Now for some company the cost of capital might be least when they have taken 90 of the debt, 10 of equity. For some other company it can be 50-50 each. So when you calculate you will know which is the least cost bearing instrument, and that's the point when you tell it is optimum capital structure, wherein the cost of capital would be lowest and the market price of the shares would be highest. Now once again, when you study capital structure, you will always have to know the nature of the industry and the specific circumstances under which your business organization is working. Okay? Now general business of your organization would be easy to understand. Now specific circumstances means things like might be the tax rate in the country itself, there might be change, or they might have come up with new rules and regulations. Okay? Now whenever things change, definitely the optimum capital structure will definitely change. Now if at all the interest goes by double of what we have to give, definitely we will go for equity. Yes? Now interest rate definitely does change by the rules and regulations of the government and the general economy that is there. Now once again we might tell optimum capital structure, okay, or for that matter a certain point wherein the cost would be least, the market price would be highest. But one thing we should remember is that it can never be decided to an exact point, or for that matter idealistic capital structure does not exist, because the market itself is a thing which we cannot predict in exact point. Yes? So when we do our analysis, what best might suit, we can select, but that definitely is going to help, we can never tell that. Okay? That's what has been given. In every firm, the financial manager has to come out with optimum capital structure. You have that sentence, but you will have to know what is optimum capital structure. Optimum capital structure is a point wherein which the market value of our organization would be highest and the cost of capital would be lowest. See, optimum capital structure is that capital structure at that particular level of equity and debt proportion where the market value of per equity share is maximum and the cost of capital is minimum. And also, as we discussed, the study of capital structure involves decision about the nature of the industry and also the specific circumstances of the business enterprise in question besides the general theory of business. Now, this is what we were discussing. It is difficult to define ideal capital structure because it is the function of business and how risky the particular business is, and therefore a matter of judgment. That is to tell whose judgment? Especially the financial manager. Whenever we speak of strategic financial management, we will be specifically speaking regarding the corporate sector or your joint stock company. Okay? There all these decisions would be taken by a financial manager. Definitely the decisions would be decided by the top management, but they would also be deciding on the basis of some study, right? That study a financial manager has to do. Now, there is a definition which has been given by Van Horn, and he tells the optimum capital structure is something wherein the marginal real cost of each available method of financing is same. Now, even this had been discussed in your last class, but let me put it once again. Now, usually there would be three chances where an organization can have optimum capital structure. The first one is when the total value of the firm would be maximum when its equity stock is at maximum. Okay? That is what the meaning we had given. When the equity shares would be maximum, cost should be minimum. So, when the equity shares are at maximum, it simply means the value of the company itself is at maximum, right? The next scenario is where the equity should be maximum on a per share basis also. Okay? Now, why that is necessary? Because the value of shares might be more, but if at all the shares are in hands of different or numerous number of people, what happens? There would be dilution of value of the company. Okay? And again there are scenarios wherein the entire value when you take would be highest, but then when you divide on per share basis, the amount what they get might be less. And the third scenario is where the optimum capital structure of the firm's overall cost of capital to be lowest. Now, it is nothing but the definition of optimum capital structure has been divided into three different things. See, now this is a simple formula, not you would not be using anything. Whatever we said until now in the form of a theory, we have just put it in the form of formula, equation. Okay? That is VM is nothing but the value of the company. It would be maximum when the value of debt, value of preference and value of equity would be maximum. Where VM is total market value of the firm, DM is value of the firm's debt, PM is value of the firm's preferred stock and EM is the value of the firm's equity stock. Took down? Shall I continue? Yes. Because this was already dealt in your last class, but then this slide wasn't there. Okay. I had said the optimum capital structure and I do remember telling it in theory wise, but this was not there. Yes. this particular slide was shown and that explanation had been given. Now this also we have already discussed regarding features of appropriate capital structure. Or features is nothing but which says when does a capital structure becomes appropriate or the one thing which is necessary for the organization or perfect capital structure. Okay. Now that has to be profitably enough for the organization for surviving in the industry. Now that is to tell, if at all you give your capital structure, you compose it of equity, you earn so much of money, and if you at all you distribute everything for the owners, what will your company has? Right? Now all those things you will have to keep in mind. Now solvency. Now regarding solvency, when we speak about debt. Okay. Now whenever an organization has, maybe you will have to take down because explanations aren't there for all these things. Okay. Now each of the point features of appropriate capital structure, neither in your handout not in the PPT you have explanation for those. Okay. Now regarding solvency, we speak regarding what happens when excessively we use debt in our capital structure. There are chances that sometimes because of the business or the economic condition, we might not be able to give away the interest. Okay? Or at all if the circumstances changes in such a way that we would be forced to pay the interest, then there are chances that it might bring a threat to the solvency of the organization itself. The organization sometimes might not have any other way other than shutting it down. Okay. So usually it is said that debt can be there in the structure of the capital to that point till where it would not bring any additional risk for the survival of the organization. Once the organization feels that because of using debt it is increasing the risk of the organization, then it would be a perfect time for the organization to decide what other kind of instruments it can use to compose its capital. Next is flexibility. Now flexibility is necessary because as and when the business scenario changes, the organization must be able to adapt along with that. Now your company might be fully of debt, yes, but then all of a sudden interest might be increasing. So you might have to go for equity. Now there are also chances that sometimes your organization might be fully made of equity, but then the interest might be zero, it might come to zero. So what will you do? Now think your organization is composed of equity, okay, major portion might be 80% might have been of equity, 20% would already be the debt. But because of the change situation and nature of the industry, on these two conditions might be the interest that you will have to pay on debt might come to zero, okay, because of some government rules and regulations. Now what will you do? You will have to change the capital structure, right? Because when government does comes for 0% interest or any percent of interest, it is not that it will come for short term, they would come for particularly long term, and during that time if your company structure is made of equity, you will have to face more expense. Certain kind of situation will not arise, But if does at least it arises in case studies, what will you do? Yes, how will you do? You are telling me that you will have to change the capital structure. That is, in the sense, we should reduce the portion of equity, we should increase the portion of debt. How will you do it? Now your equities are there in the hands of n number of people. You would never know. What will you do? The company will start buying its own equity. It will buy back its equity from others itself. The buyer would be the company itself. So all the equity starts coming back. Okay, then there are chances that it might be changed, because when a company itself has its equity, it has the full authority, right, what it can do regarding its equity. Now there are sometimes chances that the equity would be such that which can be converted. Okay, now that was just an example. Yes, the conservation is regarding the debt capital, okay, and the general cash flow. Now regarding the control also same thing, what happens when excessive equity would be given. Now after this we had spoken regarding what are the consideration that has to be made while coming up with optimum capital structure. First is return on investment. Now it usually comes to that point wherein we tell, if we use debt, whether return of investment would be more, or if we use equity, whether the return on investment would be more. Based on that you should decide. It is not on one single variable or two single variable. Now whatever we have listed, even that is not the limitation. There would be numerous amount of factors which affects an organization's capital structure, but these generally does. Okay. Next one is tax benefit, right? This is all regarding that example what we spoke. Because now tax is benefit when they have debt, because it would be calculated once after we pay interest. So much portion of cash has already gone out of the business. So you will have to pay tax on certain small amount compared to what you had to pay when you had used your equity. Okay. Now your preference and equity, here when we tell, we generalize it, right? Equity we tell, but preference and equity both are two different things. Okay. Remember in our first chapter we had said preference equity would differ only in the terms of preference of paying either the dividend or paying the principal amount when a company goes for winding up. Okay, that's why they have the name preference in the equity, preference shares. The preference would be given first. And the last one is the financial risk, that matters a lot. Yes, now there are certain other things which determines the capital structure which was not included. Okay. Now one such thing was industrial leverage ratio. Okay. It tells the debt a normal industry has, okay, in the economy. Now that particular industrial leverage ratio usually helps an organization to understand whether the business in line or whether it has moved anything further from what it has to. So now that you can take under your general determination, that factors we studied, right? Factors determination. Now under general thing you can take it down. Okay, here general factors. One more you can take down is industry leverage ratio. Then you can take seasonal variation. Now here seasonal variation does not mean your climatic season, okay. It simply means under economy when business is set up, the economy will have something called as boom stage, depression stage. That is what they mean by seasonal variation here. Now one more thing you can take down is degree of competition. Under this general factors, 10 are already there. 11th one what I said was industry leverage ratio. 12th one is seasonal variation. And the next one is degree of competition. Did you all take? Yes. Now what regarding degree of competition, how does it affect factor, capital structure? When there is less competition, they tend to take or increase the debt more, okay, and vice versa. Now why does that happen? Can anyone tell me why when there is no competition they tend to increase the interest, the debt portion? Any doubts until here? And then there are also the legal requirements, if at all, okay. Now legal requirements would be can be asked by your government or Securities Exchange Board of India. When does Securities Exchange Board of India comes into nature or interferes in your business? When does SEBI interferes in your business? Yes, SEBI is nothing but Securities Exchange Board of India, right? When will it interfere in your business, or why shall it interfere in your business? Yes, definitely. When you issue shares, you have to issue based on the rules and regulations of SEBI, right? Now there is one illustration where we shall find out the total cost of capital. Yes. Now listen to this. Now what have they given? In the first they have given debt. Debt as a percentage of total capital employed, right? Now, total capital employed would be how much? 100%, right? Now, they have given 1, 2, 3, 4 and 5 situation. Okay. Under first situation, the debt is 0. It simply means that 100% of equity has been employed. In the second instance, 10% is made out of debt. So, it simply means 90% would be equity, and the same follows for the third, fourth and fifth situation. When it is 20%, 80 would be equity. When it is 30, 70 would be the equity, and when it is 40% of debt, 60% would be equity. Now, for each situation, the cost of equity and cost of debt is also been mentioned. Correct? Now, for the first it is 10% interest, the second also the equity is 10%, for third instance it is 10.5, fourth one it is 11 and fifth is 12. And the cost of debt is 6% for first three instance, 6.5 for the fourth and 7 for the last one. Now, this will have to calculate the cost of equity, cost of debt is different. Okay? There is no connection between cost of equity and cost of debt. Now, this is the information what has been given. Now, we are expected to calculate which is the most least combination of debt and equity which attracts least cost of capital. Correct? Now, for that matter, first instance debt is 0. So, cost of debt there it doesn't actually matters. Okay? Because you have not at all taken any kind of debt. So, we shall see how to calculate this. Okay? Now, here the equity weight is given, right? What is equity? Why have we taken here 1.0? How did we take 1.0? Yes. What portion is made out of? Now, equity weight is 1 because here 100% equity is there in the first instance. Okay? That is 100 divided by 100 is nothing but 1. That is how you got it to be 100. 100% equity out of the 100% capital. Correct? So, for the second one, how much it would be? Equity weight 90 by 100 would be how much? How much? 0.9. So, when you know that here if debt weight is 1, here it would definitely be 0. Why? Because for the first instance it is fully made of equity. Correct? Now, cost of equity has been mentioned in your question. The same thing you tend to take here. Here, this 10 is what we have taken here, 10%. And the cost of debt is 6 here, the same thing would be taken. Now, speaking regarding overall cost of capital, how will we find out overall cost of capital? You have two, cost of equity cost of debt. You know what is the equity portion, you know what is the debt portion. What you should do? You should multiply the cost of equity with the portion of equity and add cost of debt on the portion of debt. Together it will give you cost of capital. Now cost of capital is being mentioned K naught. Okay. Now the way you will calculate K naught is cost of equity. KE is nothing but cost of equity. KE is cost of equity. See, here everything has been mentioned, right? KE is cost of equity. KD is cost of debt. WE is equity weight. WD is debt weight. So it would be actually cost of equity would be 10 into 1 plus cost of debt is 6, but then the portion of debt is 0, right? So 10 into 1 would be 10 plus 6 into 0 would be 0, 10 plus 0 would be 10. So if at all your equity is made up of fully shares, then cost of capital tends to come for 10% for this particular illustration. Now this how it would be for all the situations. Calculate. Now when you have equity weight 0.9, debt weight would be 0.1. When the equity weight is 0.8, debt weight would be 0.2. When the equity weight is 0.7, it is 0.3. When the equity weight is 0.6, the weight of debt would be 0.4. That simply tells 60% of equity, 40% of debt. Now cost of equity has been given in your question. Yes, sure. Tell me. Debt weight, see, debt weight is directly this. It is 0 divided by 100. It would be 0. 10 divided by 100, how much will it come? 0.1. Does it come? So if it is 0.1 out of 10, out of 1, then 0.9 should definitely be the equity weight. Yes? If you want, you can do it manually. Now if 10% is debt, what would be the equity? 10 minus 100 is 90. 90 divided by 100 would give you 0.9. Yes. Yes. Now, since you have the cost of capital for each type of debt and equity structure, now which among this is preferable for an organization or this particular organization? Now, when you do your problems, how you do is, question would be there. It is better you make a table and do. So it would be clear. Whenever you have table, you should mention table showing the overall cost of capital. And one more important thing that you will have to do is give the conclusion for all the three. Not only SFM, your tax planning should always include the note or the footnote that you give. Okay? Why you have considered something. Now, which among these five is a preferable situation for the company we have taken? See, this formula is been broken down here. KE is here, WE is here. Yes, WD is here and KD is here. So there would be no any confusion. Now KO represents overall cost of capital. Yes, which of this would be optimum capital structure for this particular company? What did we tell? The value of the firm should be maximum, correct? That particular point we cannot make out of from this illustration what has been given. We cannot decide. But the second one is that we said cost of capital should be minimum. That we have found here, right? Overall cost of capital. Now overall cost of capital is lowest for these two situations. So for this particular company, they can either go for 90% equity and 10% debt, or they can also go for 80% equity and 20% debt. In both the cases, their overall cost of capital would be less. Now this is just an illustration. This may not come for your exams, but you should know how to calculate overall cost of capital. That's why it was given. See, your SFM questions would be very simple. What matters is how you analyze. Okay? There is no such thing how you had in accounts. There is no much calculation. All we calculate here would be on the basis of EBIT, EPS, and only in the second chapter when you have to evaluate shares, there would be some formulas. Okay. Now the next one is determinants of capital structure. This is what I said already. Factors determining the same thing. Okay. Now all that has been mentioned we have discussed. You want the formula, you want the sum to complete? Did you all complete? I do not know what is going on here. Okay. Now, determinants of capital structure, it is nothing but all the elements are there in factors to be considered. Yes, tax benefit of debt is there, We have taken a problem, example for that. Why does it matters? You have flexibility, then you have control. Here what control? The ownership we are speaking under this. Okay. Then we have industry leverage ratio, which I had said that time. Now this industry leverage ratio, it simply tells the industry or the business is going in line or out of line. Because if I give too much information of industry leverage ratio, it might confuse you all. You have this under your managerial accounting, if I am not wrong. All these ratios. Okay? Now what happens is that my explanation would be different than theirs. So if I give you or if I tell you, it will be confusing. So there it is very much important. Here you need only write the theory of industry leverage ratio. So when she tells, you try to understand what it is. Okay? Then later on, if things happen such that I have said something, she has said something which might confuse you all, it is better you know what it is. Okay? There you have hundreds of ratios to be calculated under your MA. Next is seasonal variation. This also I said. Seasonal variation regarding the business season, not your climatic season. No winter, no summer. Here all it is depression, boom and stagnant we are speaking. Degree of competition, even this we spoke. Now what is industrial life cycle? Then you have company characteristics. This comes in your internal factors, right? Then period of finance you have. Period of finance is nothing but, now could it be debt? It could be equity. Now both of that, they are not the sources of organization. Today, tomorrow or at least some point you will have to give it back to those who belongs it. I mean for those whom it belongs, right? So what is the period of finance? Now debt has certain limit. Equity as such, it will not have any kind of, fixed time period, but at some point or the other we will have to give. Correct? Now legal requirement also I spoke regarding the SEBI. All these things has been discussed. Risk, cost of capital, company size, financing purpose. Now financing purpose, especially you can take it in terms of whether it is short term or long term. Growth rate. Now whenever growth rate is more, what a company does, this also I have already said. Yes? More growth rate, what happens? There would be more capital necessary. Why? Because the business is continuously expanding. And at that time, if you need, the organization to survive in the same way, you will definitely require much of the capital. Okay? You want that? Take it down. Whatever classes we do till today or we have already completed, I try putting it either in your YouTube or in your SFM group. Somewhere it would be there. Now patterns of capital structure, it is very simple. It's simply that I have put it in a slide. We said it would be made out of either debt or equity. So what are the different combinations would be there in general is what we are speaking in this slide. Okay, pattern means how the capital is formed of. Now as we said, it could be completely equity, it could be different portion of equity and preference share. Now under equity also you have different kinds, right? 6% preference share, or for that matter it could be the normal equity shares. And under equity you have different kinds. Do you all remember studying it either in your accounts, either in your business studies, first year accounts? Oh, we did not have class. We did not have class, right? First year accounts. Second semester, which subject did you have in your second semester? Practical. Accounting for managers, for me, was it there present in your first year? First sem. Second sem you had one practical paper. Which was that? Okay. No. In that it won't come. In your accounting for managers it comes. Business research is all regarding research what you do. Their accounts doesn't come. Or it could be made of different portions of equity and debentures. Okay? Or final one, it could be made of equity, preference shares and also debt. Yes. Now this is where actually your practical problem starts to come, but then even before practical you have to go through the theory once again. Now what is this capital structure? We already discussed, right? Now why do we need theories to understand it? What might these theories speak of? Definitely if it is given as theories, there is more than, yes? Now what might these theories do? Why should we study it? Now these theories speak about capital structure. What is the use if you understand theory? Or for that matter, definitely when theories would be given, it would be given by different person. Correct? Why did they all study regarding this? What was the use? Now if you do not know that, and if you do know all the formulas and the definition, it is not going to help you all. Correct? Tomorrow in interview, yes, for regarding subjects they might ask for question or two. But if you know entirely theory and if you do not know how it is useful, what will you do once after going to company? Now, all these theories, what they do is, they let us understand the relationship between the cost of equity, the cost of capital, the value of the firm and also the capital structure. Okay. Now all this theory speaks, does capital structure actually affect your organization, or there is no any use of capital structure? That is to tell, irrespective of what portion is debt, what portion is equity, your organization can survive. Or is it that by making certain portions of each type of capital, will it affect the value of your company? Now, each of the theories that we study will speak everything regarding that. Okay. The first one that we understand is net income approach. Okay. Or for that matter, it is the traditional one. Now, the next one is net operating income approach. Now, net income approach is NI, we call it as net operating income approach, we call it as NOI. Now, this is just like the title of your paper, 4 different things. What is there inside each of it, we will have to study again. Then we have traditional approach, and Modigliani and Miller approach. Now, Modigliani and Miller is nothing but the name of the two who has given this particular capital structure. Okay. Now, again Modigliani and Miller, there are two variants. Okay. When tax has been considered, when there is no tax. Now, before telling anything regarding this, now the capital structure, now each of that will tell you whether your capital structure affects the value of the firm or not. Okay, that is the base. Now it is being said that if at all the capital structure does affect the value of the firm, then what we should do? We should be coming up with that portion of debt and equity which would give us optimum capital structure. Fine. And once again telling this, optimum capital structure is nothing but where the value of the firm should be maximum. That is the main intention. Now, one more thing that you should remember is, no matter which theory we study, all these theories would stand true only because of the assumptions. Now, certain assumptions would be made for each of the theories separately, and in general also for the capital structures theory we have assumptions. Okay. Now, if at all you do not assume things, then the capital structure theories tends to stand false. Okay. That is to tell, in Modigliani and Miller I spoke two situations, one is tax, one is no tax. Okay. What happens when we take all those things, right? Now, what each of the structure speaks we shall study, but before studying we will have to see the general assumption also. Now, if I have to tell it in very brief, now this traditional approach believes that capital structure does affect the value of the firm. Okay. But then Modigliani and Miller, they have assumed a perfect market and also no tax. Under such situation, that capital structure theories are irrelevant, or capital structure decisions doesn't matter. Theory, under the assumption of perfect computation and no tax, it tells For any company, it doesn't matter what is the portion of debt, what is the portion of equity. It actually does not matter. But when the same theory, when it assumes it is not a perfect computation and that there are corporate taxes, then the result would be vice versa of what they have suggested. Okay. Now, when in your exam, what happens is that they will simply give the questions. That is where it becomes difficult. That's why I do tell, be very strong in your theory. Okay. Now, when a question comes, you would not know whether it is from your capital structure, whether it is from your leverage, or whether it is from your dividend theories or valuation of the securities. These are the 4 chapters you have under SFM. Okay. Now, they will simply give a box, they will give some variables and they will give you. You will have to first see from which lesson that particular problem is. If at all, if it is from one particular chapter, under that which does it come. Okay. Now, under capital structure, it might come from any 4 of this. For dividend theories, you have different kind of dividend theories. Okay. For your leverage, you have financial leverage, you have operating and you have combined. That also it matters. So, when a question, you will first have to see from which lesson, then from which theory. That's why giving assumption becomes important. It's very simple, but for you to decide what is the problem, it is difficult. Okay. Now, if I give that particular box, you would not know whether it is NOI, NI, MM, under which I have to do. So, what you do is table showing the valuation of the firm under such theory. Assumptions, you have taken tax, you have not taken tax. Okay, that is what you do. Now, if I give much explanation regarding that, it might again lead you to confusion. Now, what do you mean by financial leverage, by the way? Yes? What is financial leverage? Do you know? Have you ever heard of it? Leverage is something additional, something is helping. Leverage is a word of science, right? You have already studied. It is not in your PUC. It was there when we studied in our high schools, okay, which was a compulsory subject. We had leverage. Leverage is something which helps you lift something, okay, something better. Fine. Now, speaking regarding general assumptions. Now, what might be this assumptions? Why is it necessary? Because to prove a theory is true, you should have these assumptions. Otherwise, the theories will go wrong. Under Modigliani and Miller, the first instance we tell that the market is perfect. But in reality, is the market perfect? Most of the times, no. Yes? Does any of the economy in the world which prefers no tax? But what have they assumed under the first? They did tell it is a perfect market. They did tell there is no tax, right? That is where we tell all these theories are true only because of the assumptions. Fine? Now, the first and the foremost important assumption under capital structure is we always tell that there are only 2 types of capitals. Okay? The firm takes either debt or equity. There would not be any kind of preference share. Now, this is the base on which we all tell whether the value of the firm would be different if we have debt and equity proportion, or whether the capital structure decisions are irrelevant. The next assumption is that there are no corporate tax, but then this particular assumption has been later removed. Okay. First came the traditional approach, then came NI approach, then NOI, then came Modigliani and Miller. Each of that considers there is no tax. Okay. But Modigliani and Miller, when they revised their theory, they came up with the corporate tax. Why? Earlier tax was not there so much on corporate sector, but as and when the business expanded, when more and more companies came in, more and more corporations started, the corporate tax also started. Earlier individuals, they owned the business, so there might be that tax which was relevant. But now in terms of business, what corporates people do business, that would be highest. That's when corporate taxes started. Yes. Now this is also a idealistic situation, right? Wherein every company which is made out of equity, it gives all the 100% profit in the form of dividend, and it does not keep any kind of retained earnings. Whether for such organizations survival is possible? Yes? Whether they can survive? Can they? See, I have given 100 rupees in the form of equity for different people. Now I have 10 rupees in the form of profit, right? Now if I give the 10 in the form of dividend for other expenses of my organization, what shall I do? Or tomorrow, if at all of a sudden, if I need money, again the expenses increases, right? It is not that we cannot bring in cash, but what we have, if we keep it as something there inside the company, when we want the money, we can use it. At the end, at the last, whatever remains, it is for equity shareholders. That goes without telling. But instead of taking the expenses involved in that, if I have it, yes, I can use it whenever I need. Now what I keep it for myself is your retained earnings. Now retained earnings also would be in the name of the shareholders themselves, right? That also, when the company winds up, that should also be given to those who own it. But company, instead of making more and more expenses, they keep it in the form of reserves. Reserves and surplus, remember something in your accounts, that does belongs to the shareholders, right? Now this is also idealistic situation. Never in reality it happens that all the profit is given as dividend. Now the next assumption is that every time the total assets what the company takes, there would be no any change in that. Okay, that is to tell the investment decision are assumed to be constant. If in the beginning the company tells that it is made up of 10% equity and 90% of debt, to the entire life of the company, it is going to remain the same is one of the assumptions. But that is really not true, right? Because of the interest, because of the market, the way in which business does, the cost of each of the capital tends to change, right? And that's when the structure does also change of the company. But according to the assumption, it is said that the capital is always fixed. That is to tell, the amount will also be fixed, how it has been raised will also be fixed. But when company does grows, it needs more and more money. And in current situation, definitely the capitals do change. what is this year might be something else. Okay. Now I might have decided to waive all the debt I have and only depend on equity. This is the sixth assumption or fifth assumption. Okay. Now under that assumption it was that the amount is also fixed. The way in which it has been done is also remains fixed. Okay. Here what it tells is the firm's total financing remains constant. That is to tell, first illustration we took, project outlay would be 5 lakh, right? And this particular assumption tells that 5 lakh would be constant for the entire life of the company. Okay. Debt portion might increase or decrease, equity portion might increase or decrease, but the total capital that is necessary would remain constant for its entire life, which is once again a idealistic situation. Now the next assumption is the operating earnings, or what we call as earning before interest and tax, they are not expected to grow. But does that happen? There are chances it decreases, and there are also chances that when the company grows in size, it will also increase, correct? But under assumption what has happened? The EBIT tends to remain constant. Now one more assumption is that the business remains constant and is independent of capital structure and financial structure. But does risk remain constant? Risk itself is uncertainty. When something by nature is uncertain, how can it be a fixed one? Yes? The feature of risk is nothing but it is uncertain, right? So can risk be fixed? Not only that, it is also said that the business risk is not depend upon the capital structure and the financial risk. That can never happen. Okay? All those things are combined. They are like a spider web. Each thing is connected there. Each layer might be different, but they are definitely connected. The firm has perpetual life. What do you mean by perpetual life? Yes? That is continuous, never ending. The owners might die, but the company tends to remain, which actually doesn't happen. The company can also die first. And the last assumption is that, which is the most idealistic of all, that it tells that every investor will have same aim or same objectivity or the plan. Okay? But that really doesn't happen. That is to tell, when if Kirtana, she invests 100 rupees, definitely she would be expecting 10% as return on investment. Maybe she, okay? And if at all Raksha invests, she might be thinking 15% would be the return on investment. So in reality it doesn't happen. It is different for each of the individual investor, right? Why they think something about some company or what they perceive. Now don't go specifically for those words. Those words simply means the same thing, that all of them think alike. The robot themselves doesn't think alike, right? Why? Do they think? The programs does think, right, nowadays. AI, artificial intelligence. Yes. Now there is something called as notations. Now first of all, when you see that particular photo, I mean this PPT, whether it is readable, can you understand it? Otherwise I shall write it once again properly and then. Okay. The same thing I have put it in your handouts. That's why I asked. Now, usually when we study this capital structure, we will not use the entire words, right? We represent it. That is to tell, whenever I tell K naught, it is nothing but cost of capital, overall cost of capital. When I tell Ki, it is interest. Okay? Whenever it is WD, it is weight of debt. Whenever it is WE, weight of equity. That's where the notation helps. Here in this particular chapter, we tend to take 4 of that. Okay? S, B, I and V. Now this particular things comes from the textbook which I refer. Okay? Now each different textbooks will have its own notation. Okay? Its own way of solving the problem. So it is better that if you start taking textbooks, you study now itself, understand itself, see what is the difference and make a point of that. Okay? Now speaking regarding yes, it would be the total market value of equity. Okay? Speaking about B, it would be total market value of debt. I is nothing but total interest payment and V is nothing but total market value of the firm. So how will you find out the total market value of the firm? When you have the market value of equity, when you have the market value of debt, when you combine that, you will get total market value of the firm. Here where you should remember your assumption. The first assumption said the entire capital is made only either of the debt or of the equity. Even the preference is not there. That's why this formula V is equal to S plus B. Now NI is what? Net income available for equity holders. Now if at all it is only made out of debt, then net income available for the owners it is. Okay? See, I have even mentioned that. Why it is only the entire value of the firm. Nowadays if you calculate, it is not only equity and debt you add, there are many things that you have to add, the retained earnings, the remaining which goes for shareholders, blah 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 blah, there is a list, right? But here under it is only your equity and debt that you have taken. That is what has been mentioned there, something scribbled, because assumption, according to the assumption 1, there are only 2 kind of sources, that is debt and equity. Now first thing that we will have to, if at all, in our first example, they had directly given cost of debt is so much. If at all it is not given, how to find the cost of debt? Becomes important, right? Now if at all they have not given weight, from where will I come with the weight? Cost of debt is Ki. Okay? Okay. Now I represents your interest. Okay? Cost of overall capital is K naught, right? KO. That is overall cost of capital, which was mentioned in your problem. KI is cost of debt and I tend to represent interest. When you have total interest payment, yes, yes, we'll go into that. KD is also same, cost of debt only. See, debt is interest, right? So which becomes helpful for you, you take down that, okay? Or it can also be KD. So when you know the entire interest what has been paid and when you know the total value of debt, you can find the cost of debt. When you divide the interest paid by the total amount of debt, you will get the cost of debt. Okay? But if B is not given, sometimes total value of debt is not given, you can also find it by using reversing the formula, right? You do not know the total value, but you know what interest has been paid, what cost is there. So when you divide the interest by the cost of debt, the value of the debt you can calculate. The cost of equity is represented by KE. What is the next R? Whose R it is? Sir has mentioned. If it is afternoon, we can continue. Yes, 5 minutes I will book. See, now cost of equity is KE and yes, here you can also add D, right, which represents the dividend. Okay. Now it would be D1 by P naught plus G. Yes. Now a little bit of concentration is necessary over here. Why D we said it is net dividend, but again why this 1 has been mentioned here? Why is it D1? Why? Yes, net dividend, but D1 represents of the first year maybe. There might be second year, there might be third year. Yes, the same way. P naught represent current market price of the shares. With equity it is always complex. Debt is so simple, it will be there, pay interest, done, but equity so many things has to be calculated. Okay, not only you need dividend and the current market price of the share, but you will also have to add growth rate. Okay, now G represents the growth rate here. Okay, all this would be given either in terms of the net dividend is so much, current market price of the shares would be so much, expected growth rate would be so much. In the exam they would mention it like that. They will not give you D1, P naught and G. Okay, because all these notations would be different for different people. Different authors of different textbooks give different notations. Okay, so understanding theory is much more important than knowing the formula. because when you know the theory, you will know how to calculate it. If at all cost of debt is not given, but the total interest and total value of debt is given, if you divide those two, you will get cost of debt. Yes, the same thing in cost of equity. You will have to know the growth rate, you will have to know the dividend payment and the current market price. There are chances sometimes that this growth rate would not be given, okay, but then they would have given the retention ratio and also rate of return. When you have retention ratio and rate of return, if you multiply those two, you would get the growth rate, okay. Now, when it is simply written BR, it means it is B into R. Nowhere they use this multiplication symbol, okay. Now, what happens if it is 0? Yes, what happens if your retention ratio is 0? What happens? Anything multiplied by 0 is what? Or 1? What is it? Anything multiplied by 0 is always 0. Okay. So, if at all the growth rate is 0, then the formula would only be KE is DI by P naught. Okay. Now, these are the different formulas through which you can come out with KE, okay, or cost of equity. It can be found out by dividing the dividend by current market price, okay. It can also be found out by, if at all you have earnings before interest and tax, interest, and what does S represent? Total value of, what is S represented by? Yes. Or it simply is EBIT minus I is nothing but net income available for shareholders. Now, there are 3 different formulas for your KE. Okay. 1 here, 2. That's why if you know the theory, you can find out the values. Yes, this is what we calculated. Did you take down this? Shall I move to the next slide? Now, in your PPT, all those things will not come. The marking and all will not come. Okay? Don't worry regarding that. Yes, this is overall cost of capital what we calculated that time for K naught, right? Your weight of first into cost of the first, weight of the second into cost of the second. Now, this can be KDI or KI also, okay. Now, K naught you have different other formulas also, wherein if you have earning before interest and tax and value of the firm, you can find out the cost, total overall cost of capital, okay. EBIT, you know, it is earning before interest and tax, value is nothing but total value of the firm. Yes, this is what we can do when you do not know the portion of debt and portion of equity. You have total value of debt, you divide it by the value of the firm, multiply it with the cost of debt. You have total value of equity, you have total value of the firm, multiply it with the cost of equity. Now it can go that side, this side, that what has been mentioned here. Okay. So we shall stop it here. Now those who have attended